Hello everyone, today's video we're going to talk about capital reduction. Why would you choose to reduce the share capital of your limited company? So we're assuming now you're an entrepreneur, you have an owner-managed business, an SME, and you have a rather large amount of share capital on your balance sheet. So why would you want to reduce it? Well, let's take a look why. So consider the first scenario. So let's say we've got a sole trader who set up in business maybe 20 years ago. Sole trader, self-employed, and 10 years ago, this sole trader decided that they wanted to incorporate. So they'd heard that there were better tax breaks afforded to limited companies than to sole traders as individuals. So this guy transferred his sole trader business into a limited company 10 years ago. At the time, the value of his sole trader business, let's say it's £100,000, so representing the goodwill of the business. So what would the opening balance sheets of his new limited company look like 10 years ago? Well, it depends on how he transferred the goodwill of his sole trader business into the limited company, because there are two routes. So let's take a look at the first one. The first one is when the sole trader sells the goodwill. He sells his goodwill to the limited company. The limited company is brand new. It's set up from scratch, doesn't have any assets. So the company in effect says, I will write you an IOU for £100,000. So the company acquires the goodwill. It's in as an asset, £100,000. There's a director's loan, which is an IOU for £100,000. Plus there's a little bit of share capital, £100 share capital. And that is the opening balance sheet. Now, from a tax point of view, for capital gains, the guy selling the goodwill to his company, it's a taxable event. But of course, entrepreneurs relief applies 10%. He's getting paid out from his company over time from the director's loan account. There's no tax on the implications of withdrawing cash from his DLA, but he's locking in a low rate of capital gains tax when he sells the goodwill to his limited company. So that's option one, and that's what a lot of people do. But there is a second option, and the second option is option two. Now, with option two, this one here, he still transfers the goodwill across from his sole trader business to his limited company, but via a different mechanism. Under option two, we use what's called incorporation relief. Now, incorporation relief is a capital gains tax relief that says there will be no capital gains tax at the point of transfer of your business into your company, unlike with scenario one, where yes, there was a modest amount of capital gains tax, 10%. Scenario two, no capital gains tax. So we claim this thing in the CGT, capital gains tax world, called incorporation relief, which basically means you move your trade, your goodwill across to your company, no capital gain. Strictly speaking, the capital gain doesn't go away, it's just deferred. And it reduces the base cost of the shares until such time as you sell your new limited company, which could be many years or even decades down the line. So under this option two of transferring your sole trader business into a company, no capital gains tax. But what does the balance sheet look like of day one of the company? Well, goodwill, £100,000, same as before. But the share capital is £100,000. The consideration, as it were, the consideration to the sole trader for acquiring the goodwill from him, the company says, we will give you £100,000 worth of shares. That is what he's getting for transferring his business into the company. He's not getting an IOU where he can take out his cash, pay 10%. He's getting shares, no tax, but it's shares that he's getting. That's the consideration, £100,000. So on that balance sheet, it's completely different to the opening balance sheet scenario one. All he's got is goodwill and share capital to match, £100,000 of shares. So think of share capital, it's kind of locked in. You're not going to get your access to it. It's just sat there long term, locked in the business, 100 grand. How do you get access to it? Now, fast forward 10 years. So let's say, like I said, 20 years ago, set up a business as a sole trader, 10 years ago, incorporated. Now, fast forward to today's scenario. Now, assume this guy has had a bad time of it in the pandemic and the P&L reserves have been wiped out. So as you know, on a balance sheet, In addition to share capital at the bottom half of the balance sheet, you have the accumulated P&L reserves, which basically is the sum of all the profits you've ever made minus what you've taken out over time. So everything that you've left in the business will be reflected in the P&L reserve. But it's assuming you've had a bad time in COVID, which will apply to many, many thousands of businesses, and those P&L reserves are depleted, so much so that they are either zero or negative. In that scenario, you cannot pay a dividend. Now, as we know, one of the optimal ways to pay yourself as a director shareholder is via a dividend. So what we call the minimal salary, maximum dividend route. But if you haven't got any reserves, if the P&L figure is nil on your balance sheet, you can't pay a dividend. So what can you do? Well, assuming you're in this scenario and you've got all this share capital sat on the balance sheet, but no reserves, what you can do is do what we call a reduction in share capital. Now, reduction in share capital basically means you reduce the share capital on the balance sheet and convert it into distributable reserves. So it moves from being share capital to P&L reserves on the bottom half of the balance sheet, and then you have enough reserves to then pay yourself in a favorable way, i.e. via dividends. So this process of reducing share capital used to be very arduous. For years, you used to have to go to the courts to get court approval. And then the Companies Act 2006 changed the rules and said, no longer do you need to go to court. We're going to simplify things totally. Few formalities to go through, which I'll tell you about. But by and large, much easier now than it ever was to reduce the share capital. So look at the balance sheet here. Assuming you've got 100 grand of goodwill, now in reality they might have amortized that or wrote it off over time, but assuming it's still 100 grand, the share capital now would be £100. The P&L reserves would be 99,900. So you see, we've gone from £100,000 share capital to just £100, and then the difference is now P&L reserves, which can be used to pay dividend to the director shareholder. So there is a process for doing that. And the process is that the directors need to put together what's called a solvency statement to show that they affirm that the business will still be solvent after doing this and it can still discharge its debts. That solvency statement needs to get forwarded to all the shareholders who will vote a special resolution, which is 75% of the shareholders, passing the action that they agree to this reduction in share capital. And now often in small companies, it's the directors and shareholders are one and the same, but not necessarily. So director starts with a solvency statement, goes to the shareholders, shareholders ratify it, special resolution, and then the forms, the solvency statement, the special resolution are sent to Companies House together with a form here. It's called an SH19, and that just basically tells Companies House what the new amount of share capital is. So the form will say we are now capitalised with £100 of £1 or 100 £1 ordinary shares, for example, instead of £100,000 share capital. So just a bit of a formality to go through, not too onerous, but you, again, with everything, get the paperwork right so it's not challenged down the line. And then, lo and behold, you turn your balance sheet into something completely different. You've reduced capital reduction, reduced the share capital, in this case from £100,000 to £100, and then there's all this distributable reserves available to pay out. Obviously, assuming you've got cash to match, but in theory, dividends can be voted on P&L reserves and paid out later when the cash is there, which is caught up with the level of reserves. So, very useful idea if you're in the scenario like thousands of businesses unfortunately have been in the last 2 years, where their P&L reserves have been depleted because they haven't made profits. Because they haven't made profits during the pandemic, and any reserves that were there were depleted, which negates the ability to legally declare a dividend. This is a solution to get dividends reinstored by turning share capital into P&L reserves. So, just an overview there on capital reduction and how it can work for your owner-managed business. If you like this video, please do subscribe right there, and I'll see you soon.